In the previous session, we learned about the various categories of risk in agriculture. Of course, the whole point of talking about risk in this educational series is so that we can talk about managing risk. Remember, managing risk is not about trying to reduce or get rid of all risk. It is about choosing strategies that optimize the degree of risk that a particular operation is willing to take on. So how do we respond to risky prospects? The answer, of course, depends on the situation. There are some risks that we want to avoid altogether. Events that are likely to happen often, have a high probability, and have a large impact on the business when they do happen. An example might be planting a crop that has a history of failure in your area a very large percentage of the time. It's costly to put the crop out, i.e. it has a big impact, and it happens often, i.e. it has a high probability. We just avoid that risk by not planting that particular crop in that particular geographic region. For events that happen less frequently, an appropriate management response might be to try to reduce the impact if something bad does happen. For example, we try to keep equipment in good repair, and we keep some spare parts on hand, so if we have a common breakdown, we can fix it quickly and reduce the downtime impact. We employ sound production practices, vaccinate our livestock, etc., to reduce the impact of a certain disease if it hits our area. We do have to decide how much risk we want to retain so that we have some chance of earning a profit. We don't want to spend more than we have any potential of making, just trying to shed all risk potential. We know that there is a chance that even the most reliable crops in our area will not perform well if we have an exceptionally bad year. But that doesn't mean we don't ever plant anything. We know that there's a chance we could have a severe drought and not have any forage for our cattle. But we still go about our business and start the year with our cow herd intact. We may have to make some changes mid-year in either of these circumstances if things start to go bad. The general idea is that we retain risks associated with events that don't have a large impact on our business, especially if those events are not very likely to happen. In other words, we retain the risks that we think we can afford to weather or that we can manage through as they evolve. Another management strategy is to transfer risks to others. Of course, the most common example of this is buying insurance. We buy insurance to protect against high-impact events that could happen, like a building fire or a complete crop failure, events that would financially severely impact our business. Another example of risk transfer is forward price contracting or many of the commodity hedging strategies. One generic overall risk management strategy that pertains to about everything is simply obtaining more knowledge about the potential source of the risk. The more we know about things, the better we are able to assess probabilities, assess impacts, and develop specific management strategies. Under each of the general categories of risk that we talked about in the last video, we can list specific courses of action or things that we can do to help either manage, transfer, or reduce exposure to that particular risk if we determine that that is what is needed. For example, production risk can be managed by choosing enterprises that are more or less risky, by equipment or technology adoption choices, by purchasing various levels of yield or revenue insurance. Actually, crop insurance choices are becoming more and more complex in terms of the number of choices available. It's not only level, but unit structure, choosing to replace yields in the history or not, etc. Depending on the type of contract, production contracts can be a way of managing certain types of production risk. But be careful because, again, depending on the type of contract, it could actually expose one to more production risk. For example, having to fill a contract when there is a production shortfall. Diversification in terms of enterprise mix may yield some risk protection. It will be of most benefit if the enterprises are not similar, so when conditions are unfavorable for production of one enterprise, it is less likely to impact the other. In statistical terms, we say that in order to get the maximum risk reduction benefit from diversification, we want to choose enterprises that are uncorrelated. Geographic dispersion can help, as weather events may not impact all of your farm locations the same. The strategic SWOT analysis discussed in an earlier segment can help identify management changes that can be made to improve production certainty. The overarching way to manage marketing risk is to have a plan. Set marketing targets with timing objectives and triggers clearly spelled out to take the emotion out of the marketing function. Futures, options, cash contracts, revenue insurance, livestock risk protection for livestock producers, and certain types of production contracts are all ways to transfer some marketing risks to other parties. Of course, the management strategies all have a cost associated with them. Note that we have devoted an entire slide here to strategies for managing financial risk. Remember, in the previous video we pointed out that producers often underestimate the importance of financial risk, so we want to be sure to emphasize it here. Debt level decisions are a perfect example of the choice regarding how much risk to retain. As debt levels increase, of course, the impacts of low income years are magnified because debt payments still have to be made. One way to keep on top of financial risk is to keep financial records up to date and use the tools discussed in other segments of this educational series to evaluate financial position and performance often, essentially on an ongoing basis. The ability to detect evolving problems early and develop response strategies early is a characteristic of successful managers. Of course, one way to manage the financial risk inherent in any family business is to have other income or other sources of funds that can be tapped if things go south, at least temporarily, for the business. The vast majority of U.S. farms and ranches have off-farm income sources. The issue is how large are those sources relative to the potential cash shortfalls that may occur on the farm. Similarly, there may be some opportunity to manage the level of family living withdrawals from the farm business when things get a little tough. Some components of financial risk can be transferred to others through insurance or through interest hedging or locking in, for example. That last one is on the minds of a lot of producers right now. What will happen to interest rates in the near future? Enterprise diversification can help manage not only production risk but financial risk as well. Finally, having a sound overall business plan, or longer term, having sound transition and/or estate planning components of that overall business plan, and constantly monitoring progress toward the goals and objectives spelled out in those plans, along with the help of an appropriate team of advisors, is a way to manage risks inherent in a family business. Institutional risk, or the risk that some policy will be imposed or changed that will impact the business, is a difficult one to manage. Sometimes the best you can do is develop contingency plans so that you have thought about how you will respond in advance. Some things that you can do include being actively involved in trade associations or farm groups that advocate and speak on your behalf at the policy level, and locally maintain good relationships and be known as a quote-unquote good community citizen, so when local policies such as zoning are being discussed, you will not automatically be seen as the bad guy. The impact of bad things happening in the legal category can be managed by having well-written contracts for all multi-party transactions, such as leases and sales agreements. Maintaining the appropriate level of liability insurance is important, and knowing where all the important documents are kept and making sure they are all up to date is also important. Make sure your business is in compliance with all the regulations that pertain to it. This is an increasingly difficult task in this era of increasing regulations. The keys to mitigating the impacts of human risks, both personal and personnel, are communication and planning. Having that organizational chart in place that we talked about in an earlier session that spells out who is responsible for what and who reports to who else within the operation along with open communication channels, can go a long ways toward avoiding human resource disasters. Having a workload planning calendar and a labor backup plan, such as family members or others who can be called upon at the last minute to perform critical tasks, is important. Having more than one person within the organization trained to perform every task is essential. Finally, from a long-term perspective, having a sound management transition plan in place will serve the family business well. Now the hard part, which is figuring out how much risk you want to retain versus how much you want to manage in some way, reduce, transfer, avoid, etc., in each of the various categories. In other words, which of the previously mentioned strategies, or others that we did not cover in our list of examples, do you want to employ, and to what degree? The answer to that question is quite different for every farm. It depends on two criteria: your ability to bear risk and your willingness to bear risk. I simplistically think of ability to bear risk as the thickness of your wallet. How much money do you have that you could potentially afford to lose? That's a function of your cash or cash equivalent reserves, and how much of that cash is already committed to pay to others. As a general rule, farms that are in a low debt position, that are also in a very strong liquidity position, have more ability to bear risk. They can afford to lose more without putting the business at risk. However, that does not mean that they want to put all that they have available at risk. That's the second question or criteria. How willing are different individuals to take on or retain risk? That is a question of willingness to bear risk, also known as risk attitude or risk preference. That's a harder component to quantify because everyone is different. When faced with the same risky decision, different individuals may make very different choices because they think differently about engaging in risky behavior. If you search online, you can find a variety of different surveys and other tools to try to help you figure out where you fall on that continuum from very risk-averse to extremely risk-loving. It is a continuum. However, even the same person may not be at the same spot on that line all of the time in every situation. With that said, most of us probably have a fairly good idea of where we fall relative to others we know for common decisions that we face. Most, but certainly not all, people are slightly to somewhat risk-averse in most decision-making situations. That means they are willing to take on or retain some risk, but only if there is some expected payoff, reward, or profit potential for doing so. There is at least some reasonable chance that they will make a profit from taking the risk. It's the magnitude of this expected reward or payoff relative to the size of the overall risky proposition that determines the degree of risk preference or risk aversion. Are we talking about spending a few dollars to experiment with a new crop or production practice on a small piece of land, or are we talking about spending hundreds of thousands of dollars on a brand new business venture, for example? Personal characteristics such as age, generation, past financial experiences, wealth, and a whole list of other things help determine any given individual's general attitude toward taking risk. Ability and willingness become a little bit commingled here because the magnitude of other financial commitments that need to be paid in order for the business to survive is listed as critical both here for willingness to bear risk and also for ability to bear risk, as mentioned earlier. Certainly, if suffering a large loss if things go bad would put the business in severe hardship, the manager will become more risk-averse and will employ risk management strategies to help assure that that would not happen in a particular situation. For individual situations, the degree of willingness to bear risk may also change depending on the magnitude of the risky situation. For example, An individual may be willing to take risk if the maximum loss that could possibly occur if things go bad is only a few dollars. But that same person may become very risk averse and employ a variety of risk management strategies if the maximum loss that could occur without any mitigation in place is thousands or hundreds of thousands of dollars. If, for example, they could lose the entire value of the wheat crop if drought or freeze wipes it out. Finally, as individuals learn more about a risky proposition, they in general tend to be willing to take on a little bit more risk. In all cases, from a farm management decision perspective, it boils down to comparing expected benefits versus expected costs. The stronger the degree of risk aversion, the higher the value that will be placed on the ability to reduce, transfer, or avoid the risky situation. The costs of risk mitigation strategies are generally more straightforward. What does it cost to purchase this particular level of insurance coverage, for example? As a general rule, we employ risk management strategies to in some way mitigate the risks that we don't think we can afford to retain internally. If the benefits of risk reduction appear to outweigh the costs of a particular risk management strategy, we employ that strategy. In reality, farm managers are faced with so many different risky decisions that they need to become very skilled at making these benefit versus cost choices fairly quickly in many instances, so that they save an adequate amount of their valuable management time to formally collect information and evaluate the really big choices that they're faced with. As a final thought for this session on risk, and to expand a little bit on a point made earlier, surveys and other research has confirmed what may be obvious when we stop and think about it. That is, the way a business manager thinks about risk is a little bit different than the way an analyst or a statistician might think about risk. The analyst is likely thinking about the total range or variability of possible outcomes, including observations that might be better than expected, as well as observations that might be worse than expected. Business managers may well be aware that this is how risky situations are described, but in reality, they may also only really be concerned about the outcomes on the negative side of the range of possibilities. For example, in a given year, maybe we expect calf prices to be $2 a pound, with a 25% chance that they could be above $2.50 and a 25% chance that they could be below $1.50. Managers often don't worry too much about employing risk management strategies to mitigate the impact on their business if prices are above $2.50, but rather they focus on what would happen if prices fall below $1.50. In some cases, the strategies they employ to manage the downside impacts might also negate the chance of gain if the outcome is abnormally positive. Straight hedging or flat price contracting, for example. But in other cases, this might not be so. It might be perfectly logical for a manager to pay a premium for a risk management strategy that mitigates the downside risk while leaving some ability to capture the benefits of a positive outcome. These sessions have just been an overview of risk in agriculture. Many other resources are available to assist managers in the difficult task of evaluating and managing risks appropriately.